Hello. In this video, I'm going to talk about a recipe I spent the day working on. This recipe is in preparation to a change that I plan on building into Jackrabbit's relay. The change is going to be on the basis of limiting the number of assets or maximum positions. But to do that, I wanted a recipe where I could focus on very limited exposure. So let's talk about this recipe. It is the Bollinger Bands and Parabolic stop and reverse. This has been significantly modified. It is split channel and it is using a very unusual volatility reference. So let's get into the gory details. This does not use confirmation as it doesn't need it. Okay, so as you can see, we have the high and the low for the split channel, and I want a super smooth moving average. Now, I want a very unusual look-back period. This is a prime number, and it is not something you will commonly see. The second part of this is the standard deviation. I'm looking only for the most extreme volatile movement. That's it. So I want an upper and lower deviation of 4. Now because of the limits, I need to keep the candle 5 bars. That is so it will line up with the parabolic stop and reverse. And it also is rather interesting. This part is pretty cookie cutter, but you'll notice I'm keeping the signal for 7 candles. So I'm using lagging and leading combinations at the same time. Parabolic stop and reverse is a leading indicator. Bollinger Bands is a lagging indicator. So let's see how well these work together on some coin choices. Okay. So 3 cycles, 2% profit, 7 maximum positions. Let's find one of those cycles. Okay, here is the selling point of the cycle. Okay, let's get this really zoomed up. Now I'm going to hide the DCA module for just a second. Notice this candle crosses above. This crossing back into the zone. This is a 4% standard deviation from this upper median boundary. That's extreme volatility. If you look at the parabolic stop and reserve, you'll see it peaking as well, but we're not really worried about what it has to say. I want a simple take profit. Now you can change this to strategy, but you will be in the market a little longer. For the purposes of this recipe's intention, I went out as fast as possible. But definitely go ahead and take a look at it and tweak the numbers. This actually does have some pretty interesting side effects. Okay, let's find the buying position. Quite a bit of the market gets completely ignored by the way this is set up, looking only for the highest level of volatility. Okay, let's zoom in. And here you have volatility that lines up. Now, this is a little bit ahead of the game, but you can see leading, lagging, working together. And that's what we want. Now let's zoom back out. And we see a position that took on a little bit of accumulation. But notice it's not very much accumulation. Very limited. And that is what we want. Very limited. So the leading lagging combination works out very well. So let's see how this would work on a few other coins. Okay, I'm going to zoom into the DCA module so that we have the statistics more apparent. So 3 trade cycles, average of just over 2% profit, 7 maximum positions so far for this recipe. Now let's see how that's going to handle through different timelines and different time frames. Okay, 5 of maximum. This one doesn't find any at all. Also nothing. Only one position here, excuse me, one trade cycle. As you can see, the higher you go in time frame, the more restrictive it becomes. That means the better it works with higher positions. This recipe could easily handle $100 or $200 positions and not break a sweat. Even if you go to the lower time frames and go insane. Then and only then do you get the craziness. But for 2 trade cycles, that tells you just how steep one of these is. I do not recommend low time frames like this though, simply because you won't be able to keep up with the alerts. The 1 minute is more than enough, and it offers a good number of positions without getting crazy. Now you'll notice the USD versus the USDT. 7 positions for USD, only 2 positions for USDT. That means there's more volatility on the USDT stablecoin than there is on the USD fiat. That can be important if you're looking for more frequent trades, or less exposure, or both. Here's another 7. Let's see if we can find an absolutely horrible coin. And this is starting to get up there a little bit in positions, but still not bad considering. Ah, yes, love it or hate it, BAT is trying. But 13 positions at the 1 minute is not something to sneeze at. It still can pull off good profits. Bitcoin Cash is another one capable of good profits. Now we're getting into the low quality junk. And yet, even then, still very limited positions. Even with this coin, at $10 positions, this is only $100 max for a budget and exposure. That is reasonable. Of course, you will want $200 if you follow the golden equation, but still, limited amount of exposure is good. Again, you see the difference between the USD market and the USDT market. More volatility here than on the US dollar. More volatility means less exposure, more trades. Another coin that has caused heartburn quite a bit over the years. Okay, 11 and 20. Significantly more volume and volatility on the USDT market, even with this coin being a real pain sometimes. This is something that simply cannot be ignored with this kind of recipe. Now you'll notice something here, and that is the higher market cap coins do not necessarily have a lot of volatility. There's good and bad to that. Less volatility is less number of trade cycles for a recipe that simply lives on volatility. The good to it, though, is that when you see volatility hit the market, you know your positions are going to be either very good entries or very stable exits. Some of these coins are quite surprising in terms of how well they produce results. But that is what this particular recipe is meant to do. Get in only at the best opportunities with limited amount of exposure. This is a recipe where you make your profit on the basis of your position size. It is not something you're going to be using $10 positions for in order to break even. It is something you're going to be using $100 positions for in order to break even and make a good profit. at $100, 6 trade cycles. Okay, let's see, 6, 12, so about 3 positions. So you're looking at 12%, tongue-tied there, of 3 positions. That's $30. You're looking at roughly $3 an average. That's pretty good, especially considering that's every 3.5 days. Now let's pick a coin that is just vicious, brutal, unforgiving, and a general nightmare. Choice number 1 looks very good. Very little exposure, very good profit. But now let's go find one of my nemesis coins. A coin that has cost me a lot of money over the years. A coin that is hard to get out of, has poor liquidity, horrible volume, and is just all around very brutal. And here you see it did well. But we're not done yet. Let's see what other tidbits we can find. Simple, sweet, and very, very controlled. $100 position here, $2 profit. That may not seem like much, but when you figure that some of these coins are just nightmares to deal with, have channel locking issues, and just aren't that good with market liquidity, this is pretty good. And here's an example of a coin, 1 position only, and yet look at this horrible, hideous market. This is a coin that you just want to go away. But in the end, when it does make its profit, it's going to be very good, very reasonable, and very limited. So here we go. Here's where it started. 1 position only. It's not something I would necessarily put a lot of money in. But if I was trading multiple coins, I would definitely throw $10 or $20 in this direction and be quite happy about it. So let's go back over the settings. Split channel, high and low, super smooth moving average, and a very unusual median. And only the most extreme volatility. Holding on to the candles, or holding on to the signal for X number of candles, lets you line up unusual markets and look for a good, solid entry. Now let's look at the parabolic stop and reverse again. By themselves, these aren't necessarily going to get you anywhere very fast, but the combination does exceptionally well. Even with price aggression, very limited, very controlled, and very, very profitable. So whether you're looking for a recipe that has very little accumulation or a recipe that is very defensive to maximize your market exposure, examples like this are very easy to see why they're good choices. Share this video if you know somebody that's looking for a good approach. Like, comment, subscribe if you haven't already. Until next time.